highly requested video, the ultimate guide to swing trading for beginners. Swing trading is a great way for students or part-time traders who are too busy with their regular 9 to 7 job to make some side income. It's overall a lot less time-consuming than day trading and takes less starting capital and a lot less risky. If you struggled with day trading or looking at charts all day, then swing trading is definitely for you. In today's Ultimate Beginner's Guide to Swing Trading, you're going to learn getting started with swing trading, the right mindset and expectations. Because spoilers, you're not going to start banking Lamborghinis in 2 months. Then you'll learn about technical analysis for swing trading. You'll learn about the time frames as well as indicators. Next, we'll talk about swing trading chart patterns, my recommended swing trading brokers, and last but not least, once you've gone through all the foundation listed above, then you're ready to learn my favorite swing trading strategy. As always, if you enjoy educational videos like this, please remember to drop a like down below and subscribe to see more. First, let's start with how to get started with swing trading. Why should you even choose swing trading in the first place over day trading? Through my many years of day trading, I've seen many pro day traders gradually transition to swing trading, and there are very good reasons for that. When you day trade, you're entering positions intraday, often in the first 2 hours of the market open. And you are closing the position in the same day in a couple of hours, minutes, or sometimes in seconds. This kind of environment is very fast-paced, high adrenaline, and yes, you could make a lot of money really fast, but you could also lose that same amount of money just as fast. So it's really stressful. And after over 10 years of day trading in that kind of high-stress environment, I wanted to slow down a little bit. So that's the reason I started swing trading a lot more last year. Swing trading means instead of holding a position for a couple seconds, minutes, or hours, you're holding the trade for more than 1 day, sometimes weeks or even months. So you can see just from the longer holding period for your positions, that means you don't have to care about the intraday fluctuations of day trading. Which also means you don't need to sit in front of the computer looking at charts all day, looking at tickers. It's less time consuming overall, and generally it's less stress for the trader and requires a lot less capital. Now, of course, there's also downside to swing trading as well. I'm not just gonna talk about the good and not the bad. Because of everything I shared earlier, swing trading generally leads to slower account growth compared to day trading, at least for most swing traders. You can also flip the other way around as well and see swing trading as less risky, and it's less likely that new traders will lose their entire trading account in 1 day, because that's something that's very possible in day trading. Trust me, I've seen that happen to many day traders, and had that happen to myself as well when I was starting out as a beginner. So if you're actually interested in learning swing trading, then you just need to be prepared for a much slower action. Instead of using the fast-paced intraday charts, you should be looking at the daily stock charts or even the weekly charts. And don't worry, we'll be going through all the technical analysis and chart patterns in the next section of the video. If everything I just said sounds appealing to you, then let's move on to the next part, technical analysis for swing trading. Now let's dive into the exciting part of technical analysis for swing trading. We'll be talking about charting timeframes, indicators, and supply and demand key levels. Let's start with the most important aspect, charting timeframe. In trading, time frame of a chart refers to the length of time that a trend is presented in a market. It is used by both day traders and swing traders to analyze price movements and make decisions based on their trading styles and strategies. So in day trading, most traders will use smaller time frames, such as the 1-minute chart or the 5-minute chart. But in swing trading, the lowest time frame most traders use is the daily chart, then the weekly chart, and sometimes even the monthly chart. If you think about it, this makes a lot of sense. You're holding positions for days, weeks, or even months, instead of a couple of minutes. So you shouldn't let every single tick on smaller time frames distract you from the bigger picture. And that's why the daily chart, which you can see up here, this is the default for most swing traders. This is the chart that I use the most, as well as the weekly chart that you can see over here. I only use smaller time frames such as the 5-minute charts or the 15-minute charts that you can see here to execute my entry orders. Next, let's talk about the concept of supply and demand. This is a very important aspect of technical analysis to understand, especially if you're doing technical swing trading, which is the kind of strategy I'll be sharing with you later in the video. On the daily chart over here, you can see we have the stock, Google. Have you heard of them? You can see backing around June of last year, the stock peaked around this 190s area and pulled back all the way down to this area. Let's call it 168, 165s here, and then bounced off and went even lower to 155s, then down here to, let's call it 149. At each of the lines that we just drawn, you can see that the stock, after selling off from these levels, it kind of bounced off that area multiple times. You can see here, it bounced off this 164s, went back up to 173s, and went even lower to 155s, came back up to 165s area, and sold off to 150s. And then after that, bouncing over back to the levels of 165s again. And the reason the stock bounced at these green line, these areas, because there were buyers there waiting to buy the stock. There is demand there, which is why these areas are called demand zone or support zone. In general, these are areas of interest for buyers, and these are the areas where you should look for your potential swing trading entries. Now back to the charts here. You can see that after the stock bounced off these green lines, it went all the way back up to the 174s area. After it bounced here, it went back to 164s, 150s, back to 164s. Then it went back to highs over here around 180s. Then again, after it bounced off this support area, it went back to new highs around the 190s we talked about, and even 200s up here. And after the stock peaks at these red lines areas, it pulled back, meaning that after hitting those levels, you can see the stock go back down lower, sometimes even selling off drastically. You can see that will be the example here. After hitting this 181s, it sold off drastically back down 20 points lower. Same thing here. After it hit 200, it pulled all the way back down to 188. And the reason the stock pulls back at these red lines that you see here on the screen is because there were sellers there waiting to sell the stock and get rid of it. There is supply. That's why these areas are called supply zones or resistance, basically the opposite of demand or support. These resistance areas are where you should look for potential exits to sell and take profit on your swing trading positions. I do want to make one thing really clear though. These support and resistance lines are